Let me now turn over the screen to my co-organizer, Andreas Dombret, to introduce our keynote speaker, Augustin Carstens. Andreas, the screen is yours.
Thanks, Patrick, and good morning to everybody, or good evening, should you be tuning in from Asia. How do you introduce somebody who does not need an introduction? I'm, of course, talking about Augustin Carstens, and the best way of introducing him is introducing him as an economist. He has a illustrious career. He is, since December of 2017, the general manager of the Bank for International Settlements, the bank of the central banks, but he had a life before the BIS, just before the BIS, and that's how I got to know him. He was governor of the Central Bank of Mexico, and before that he was, without being affiliated to any partner, the finance minister of Mexico, a important G20 country, and before that he was the deputy at the International Monetary Fund. So a lot of public service for Augustin Carstens. He actually spoke at the Goethe University several years ago in an important speech. So in order to save time and have more time for his intervention and for his keynote address, Augustin, the floor is yours, and thank you for joining us this morning.
Well, thank you, dear Andres, for this very kind introduction and for inviting me to speak today. It's an honor to deliver this speech at Goethe University. Of course, I wish I could be in Frankfurt in person. In a speech 4 years ago, as you mentioned, in this house, I addressed the growth and pitfalls of cryptocurrencies like Bitcoin. Since then, the debate on the future of money has grown much broader, but it continues to touch on the very foundations of the monetary system. Today, I will take inspiration from the great Johann Wolfgang von Goethe, a true Renaissance man, a poet and a novelist, a playwright, scientist, and statesman. Remarkably, his work anticipated some key economic issues of our time, including central bank independence. Goethe's work confronts fundamental questions. In his masterpiece, Faust, he addresses the Gretchenfrage, the fundamental questions of life. For central bankers, the Gretchenfrage has always been, what is the soul of money? Today, technologists, innovators, and futurists are coming up with new answers to this question. Some say that in the future, money and finance will be provided by just a few big tech corporations. Others dream of a decentralized system in which blockchains and algorithms replace people and institutions. And maybe all of this will take place in the metaverse. My main message today is simple. The soul of money belongs neither to a big tech nor to an anonymous ledger. The soul of money is trust. And central banks have been and continue to be the institutions best placed to provide trust in the digital age. Let me elaborate, starting with the institutional foundations of money. Money is a societal convention. People accept money today in expectation that everyone else will accept it tomorrow. At its core, trust in the currency holds the monetary system together. Like the legal system, this trust is a public good. Maintaining it is crucial for the effective functioning of societies. Trust requires sound institutions that can stand the test of time, institutions that ensure the stability of the currency as the economy's key unit of account, store of value, and medium of exchange, and that guarantee the safety and integrity of payments. Over history, independent central banks have emerged as a key institution to provide this trust. Alternatives have often ended badly. It is for good reason that most countries have established central banks with clear mandates to serve society. In pursuing these mandates, central banks have managed to constantly adapt to technological, economic, and societal changes. This is why central banks are actively engaging with digital innovation, developing public goods such as wholesale financial market infrastructures, retail fast payment systems, and central bank digital currencies. Of course, in a market-based system, the private sector remains the main engine of the economy. In today's two-tier monetary system, deposits are by far the most prevalent form of money held by the public, since cash holdings are relatively small. Banks, in turn, place their own deposits with the central bank as bank reserves. In this case, central banks provide an open, neutral, trusted, and stable platform. Private companies use their ingenuity and dynamism to develop new payment methods and financial products and services. This combination has been a powerful driver of innovation and welfare. But we must not take this successful symbiosis for granted. Some recent developments may threaten money's essence as a public good, if taken too far. To illustrate, let me offer three plausible scenarios for the future of money. In the first, big tech stablecoins compete with national currencies and against each other, fragmenting the monetary system. The second relates to the elusive promise of crypto and decentralized finance, or DeFi, which claims to offer a financial system free from powerful intermediaries, but may actually deliver something very different. The third realizes the vision of an open and global monetary and financial system that harnesses technology for the benefit of all. You can probably guess which vision I espouse. Let's start with stablecoins issued by big techs. Stablecoins are cryptocurrencies that base their value on safe assets, such as currencies and other regulated financial instruments. They piggyback on or borrow the credibility of these safe assets. Big techs have made important contributions to financial services. Their new and innovative products have allowed hundreds of millions of new users to join the formal financial system. In the process, they have also achieved systematic relevance in several major economies. For example, big techs provide 94% of mobile payments in China. This trend could accelerate if one of these firms were to create a dominant closed ecosystem around its own global stablecoin. Once established, a company is likely to erect barriers against new entrants, leading to market dominance, data concentration, and less competition. Its stablecoin could disintermediate incumbent banks, posing a risk to financial stability. Moreover, if one big tech stablecoin takes hold, others will seek to imitate it. We may end up with a few dominant walled gardens competing against each other and with national currencies, fragmenting the national and global monetary system. The initial benefits would fade, quickly giving way to well-known problems of market concentration. In addition, the same economic forces that foster inclusion can also cause discrimination, privacy violations, and market concentration. One reason is that data are subject to large externalities. For example, one person's data can reveal information about others. Moreover, it is possible that the data holder ends up knowing more about users' behavior than the users do themselves. Armed with exclusive access to data, big techs can quickly scale up and dominate markets. Let me be clear. It is undesirable to rely solely on private money. Paying with a big tech global stablecoin might be convenient, but in doing so, users may be handing the keys to our monetary system over to private entities driven primarily by profits. Such an arrangement could erode trust. A public good like money needs oversight with the public interest in mind. A second plausible scenario for the future of money has attracted a growing number of enthusiasts. This vision replaces institutions with distributed ledger technology, or DLT, and in principle allows anyone to be a validator in a shared network. It is embodied in the growth of cryptocurrencies and applications that build on them, such as so-called decentralized finance, or DeFi. DeFi's enthusiasts hold out some very appealing promises. DLT will democratize finance, cutting out big banks and other middlemen. The internet itself would become decentralized in what many like to call Web 3.0 or Web 3. In this world, data are reclaimed from the big techs, while entrepreneurs and artists keep a greater share of the value they create. Decentralization can be a noble goal. In many applications, governance improves when power is genuinely dispersed, with appropriate checks and balances. But this principle is not what DeFi applications are delivering. There is a large gulf between vision and reality. Today, the DeFi space has been used primarily for speculative activities. Users invest, borrow, and trade crypto assets in a largely unregulated environment. The lack of controls such as know your customer and anti-money laundering rules might well be one important factor in DeFi's growth. Indeed, a parallel financial system is emerging, revolving around two elements. The first is automated self-executing protocols, or smart contracts. But these contracts will never be so smart as to cover every possible scenario, and someone must therefore write and update the code and run the platform. In practice, there is a lot of centralization in DeFi's. BIS economists have discussed this decentralization illusion in recent research. The second element is, again, stablecoins. These grease the wheels of DeFi. As they aim to maintain a fixed value to fiat currencies, they allow transfers across platforms and form a bridge to the traditional financial system. Stablecoins are the settlement instrument in DeFi, alongside governance tokens and other more volatile crypto assets. But stablecoins may not be sound as money. One drawback, as I mentioned earlier, is their borrowed credibility. Their issuers have an incentive to invest reserve assets in a risky manner to earn a return. Without appropriate regulation, issuers can diverge from full backing or become creative on what counts as a safe asset, as experience has repeatedly shown. More fundamentally, decentralization has a cost. Trust in an anonymous system is maintained by self-interested validators who ensure the integrity of the ledger in the absence of a central authority. So the system must generate enough fees or rents to provide these validators with the right incentive. These rents accumulate mostly to insiders, such as Bitcoin miners, or those who hold more governance tokens. These rents are also a reason why DeFi platforms have been so attractive for venture capital investment. Many protocols entrench insiders since those with more coins have more power. Ultimately, this means high costs for users. So while insiders often make spectacular returns, efficiency gains for average users have so far failed to materialize. And in the absence of regulation, fraud, hacks, and so-called rug pulls have become rampant. In addition, this structure makes it hard for fully decentralized systems to scale up. Achieving agreement in a large network takes time and effort and consumes energy. The larger the ledger, the harder it becomes to update it quickly. This is why many DLT systems can only handle a small volume of transactions to date and often suffer from network congestion. This is the reason why Bitcoin requires so much electricity. Indeed, the necessity of rents to maintain incentives in a blockchain is a feature, not a bug. It is a case of the more the sorrier instead of the more the merrier. And the proliferation of blockchains means that many are competing to be a single arbiter of truth. Meanwhile, DeFi is subject to the same vulnerabilities present in traditional financial services. High leverage, liquidity mismatches, and connections to the formal financial system mean vulnerabilities in DeFi could undermine the stability of the broader financial system. As with money market funds, stablecoins could face runs during a shock. With automated protocols, there may also be unpredictable interactions as liquidity dries up and losses cascade through the system. Thus, there is a risk that this magic, once launched, may spin out of control. As in Goethe's Zauberlehrling, DeFi applications could take on a life of their own. When a crash happens and money is lost, users will inevitably turn to a trusted and experienced party, the public authorities, to tame the unleashed spirits and restore order. A better approach is possible. Building on sound money, new applications could stand on a stronger footing. They should not be based on anonymity, but on identification and trust. And they should comply with financial regulation designed to keep the system safe. Wherever private stablecoins are issued, they need to be adequately regulated to address risks such as runs and the concentration of economic power. We also need effective and consistent international policies. Innovators should not fear regulators, but work with them to make their products sounder and more sustainable. In a third scenario, incumbents, big techs, and new entrants compete in an open marketplace that guarantees interoperability, building on central bank public goods. End users can seamlessly interact across different providers, both domestically and across borders. This would bring about continued innovation and ever better outcomes for the economy. Trust in money remains the bedrock of stability, and users would see low costs and convenient services with safety, privacy, and a broad range of payment choices. This scenario harnesses the benefits of big data and DLT with market structures that foster competition and promote the public good nature of the monetary system. The monetary system is not fragmented into separate walled gardens, nor is it dominated by a few large corporations. High rents for insider validators are no longer needed. At the core of this system are central banks. They do not aim for profits, but to serve society. They have no commercial interest in personal data. They act as operators, overseers, and catalysts in payment markets, and regulate and supervise private providers in the public interest. Working together, they can provide central bank digital currencies. Unlike stablecoins, CBDCs do not need to borrow their credibility. As they are directly issued by the central bank, they inherit the trust that the public already places in their currency. They can thus serve as a sound foundation for future innovation. Central banks can provide this foundation domestically, but also on a global scale. Imagine a global network of CBDCs. Different central banks would design and issue a new form of public money tailored to their economies and society's preferences. Importantly, central banks could work with one another and with the private sector to ensure that these domestic CBDCs are interoperable across borders. This requires technical compatibility, the ability for systems to speak each other's language, and agreement on rights and obligations. To arrive at that point, they could choose whether to build a network of bilateral links or use a hub-and-spoke model or a single common platform. DLT could connect multiple CBDCs issued by different central banks. This would be useful as no single central bank would be able to straddle all the different currencies in the system. Such a network would be a global version of domestic monetary systems grounded in the trust placed in central banks. It could lower the cost of cross-border payments, increase their speed and transparency, and broaden access to users in different countries. Private providers could interact with clients, conducting Know Your Customer and other compliance checks. The private sector could build a host of financial services on top of such a system, from innovative payments to lending to insurance and investment services. But safeguards could give users control over personal data. This would not require the selling of speculative coins that serve only to enrich insiders. The BIS Innovation Hub is working actively with the central banking community to make this vision a reality, with several experiments involving cooperation between central banks and the private sector. What is notable is that many of these projects are based on DLT, where the central banks play the key role. Based as they are on trust instead of rents, these systems have no problem with scaling up. They also offer greater safety and efficiency. 3 important BIS Innovation Hub projects use DLT platforms upon which multiple central banks issue their own wholesale CBDCs to enable faster, cheaper, and safer cross-border settlements. Overall, these projects show that there is significant potential in new technologies, including DLT, if they are applied in a way that builds on the monetary system's existing institutional framework. Central banks, as validating nodes, are not there to make money by mining coins. Instead, they perform this role as part of their public service mandate. Let me conclude. The future of money is ours to shape. While central banks share the excitement around digital innovation, we are aware of the potential consequences of some of its incarnations. The design of money has consequences that concern all of society: the integrity and stability of money and payments, market concentration, consumer rights, and efficiency. Hence, central bankers must work with other public authorities and private stakeholders if we are to make the vision I have described a reality. Let's innovate in a sound, sustainable way, harnessing the benefits of digital technology in a way that is consistent with our shared values. In particular, let's ensure that our financial system builds on the existing governance of money, serves the public interest, and works cooperatively with the private sector. So let me go back to where I started, to Goethe. The answer to the Gretchenfrage has not changed. Central banks and public authorities are still the glue that holds the monetary and financial system together. Private sector services and innovation are essential and should thrive on this foundation. But trust can never be outsourced or automated. Herzlichen Dank für Ihre Aufmerksamkeit.
Dankeschön, Augustine. Thank you very much for your very rich intervention. Thank you also for reminding us of the soul of money. Your intervention couldn't have demonstrated in a better way that Patrick and I picked a good topic, and no wonder that so many people have tuned in, because this is really at the core of the financial center. And thank you very much for your three plausible causes. We do have, and you have kindly agreed, we do have time for one or two questions. And let me start out, going to the core of your third plausible scenario, which is a network of central bank digital currencies. Now, my question to you would be, as you clearly see a role for the private sector in this, and not only for the public sector, how in such a system, how can one motivate the commercial banks and the other innovators to take part in that system, and to ensure that this is also very much to the benefit of the users? What are your thoughts on the private sector being involved in your third plausible scenario?
Yes, thank you very much, Andreas. This is a key question. I mean, certainly, as we move from broad ideas to more specific issues, as it is always said, the devil is in the details, and the incentives that you are mentioning is very, very important. Certainly, what we want to do is to build on top of the infrastructure we have, not only the central banking infrastructure, but also the banking system infrastructure. Now, I think probably the main issue that we should try to capture is the tremendous efficiency gains that would be generated by starting with a clean page, I mean, I think that today, for example, in cross-border payments, in correspondent banking, and in other aspects, something that is tremendously difficult for the banking system and authorities is to overcome legacy issues. It's very difficult to implement a complete new and efficient technology on top of the legacy systems. Now, one of the things that CBDC can do, and that's what we are exploring, and I can say that we have made tremendous progress here, is that it opens huge technology potential. As a matter of fact, very similar to what is being created out there by fintechs and innovators. But this would be ordered, this will be structured, and this would be based on solid foundations. So I think that the promise of a clean slate should be a tremendous incentive, because banking institutions and other payment service providers, financial providers, want to jump into innovation, but one of the competitive disadvantages they have is that they have to deal with their legacy. So this is a way to sort of leapfrog that legacy.
Thanks a lot, Augustine. But we have time for maybe a last question, and let me go to a little bit more of a frightening scenario, which you mentioned, and that was the scenario if there would be a shock to the DeFi system. Now, if we were to have such a shock, the likelihood that we have a cascade of losses running through the DeFi system is quite high. I remember, and we were both on a committee which you chaired at the BAS, the SCAF. I remember when we discussed the 2008, and when we discussed the shadow banking system, and what kind of shocks we had when we saw runs, for example, on funds, which you can't compare, but all those shocks which can potentially come. Now, what would central banks, or what could central banks do in such a negative scenario if you were to have such a shock to the DeFi system? If we go back to 2008, regulators and supervisors had very little they could actually do in that case. So what would be your thoughts on such a hopefully never happening, but still potentially possible, shock?
Well, your intuition is the correct one. I think authorities would have very little, not only capacity, but also reason to intervene, you know. I mean, I think that at the end of the day, the key issue here is the systematicity of the system. And what is important is that this system, DeFi systems, do not become systemically important. And that's something that we as authorities and as societies, we need to really look after. As you know, oftentimes interventions by authorities has been triggered by too big to fail, too important to fail, or too, I would say, essential to fail in terms of market functioning. So when these systems acquire systemic dimensions, there might be some justification for intervention, but precisely we should move fast and try to prevent that these systems acquire systemic importance without adequate supervision and regulation.
Yeah, thanks, Augustine. I thank you hugely on behalf of also Patrick for your very, very important intervention. You set the stage for this entire conference, and as you know, there will be a book at the end where we collect all these ideas so that these ideas can be read. We also will post your speech as well as the the video of this discussion and the Q&A on our website. We need to stay in. We have a tight schedule, so we need to stay in that schedule. So I send you my very best wishes to Basel. Thank you very much, and hope to see you next time at Goethe University in person.
That would be my pleasure. Thank you very much.